Perfect. So my name is Ryan Day from Calvert Home Mortgage. I've been with the company for the past 3 years. And what we really focus on is help serving real estate investors, primarily people who buy, renovate, and sell, or buy, renovate, and refinance in Alberta and Ontario. Company's been in business for over 45 years, primarily serving people who flip properties. We've been in Ontario for the past 4-ish years, but over 40 years in Alberta, primarily in the Calgary market, and then also Edmonton as well too. What really makes us unique is we focus on extremely short-term lending, which I'll be getting into the nuances of our financing, but we love helping serve real estate investors or people who buy, renovate, and sell, buy, renovate, and refinance, who plan to exit the property in under 12 months. So I know that there's hundreds, if not thousands, of individual lenders, mortgage investment corporations, hard money lenders, and any other abbreviation that you'd like to use. This is essentially what really makes us unique in the marketplace. So I'll just be essentially getting into our products, a few case studies as well too, sharing our Excel document on what we use in order to underwrite deals that I'll be sharing with the audience as well too. And then after this call, this whole presentation will be sent out along with all of our materials and a list of wholesalers as well in both Alberta and Ontario that we do quite a bit of business with in order to help assist with finding the right opportunity for your next project. So essentially, what makes us really unique is that we are able to fund deals extremely quickly. So in 1 to 2 business days in Alberta, and then in 2 to 3 business days in Ontario. So we're really known for extremely quick turnaround times. And how we're able to offer that is because we value properties as if complete or as is, depending on if you're doing renovations or not. And if you are doing renovations, we take into consideration your renovation plan, and we let you know what our analysts value the property at as if complete, and we only provide a mortgage if we see you making a profit of minimum $20,000. Typically, it's not within or close to that $20,000 range. On average, what we see is around of clients of ours, people who make anywhere from $40,000 to $100,000. It obviously really depends on the property type, location, and obviously your purchase price as well too. So because we're able to do our own in-house valuations, we do not require third-party appraisals. And obviously the benefit to yourself for that is that you save a few $100s on the appraisals, but more importantly, time and effort as well too, of not having to schedule an appraisal, and the cost and headache associated with that, especially if there's a quick closing. We are known for having a low money down options as well. So if you don't have the capital for 20-25% down, we have options where you can purchase a property with as little as $20,000 down in Ontario, or as little as $10,000 down in Alberta. We also have rates for 5%, 10% down, 15% down, and then your typical 20-25% down as well too. All of our mortgages are fully open. So something, even if you don't choose to use our services, is to really understand the fees, prepayment penalties, legal fees as well too, and then renewal fees. So for us, our mortgages are 6 months fully open, so you can pay it out at any time. Say if you close on the property and then you pay us out in 16 days, you're only charged 16 days interest. So typically there's 3 months prepayment penalty. Obviously, this can change from lender to lender. So if you are flipping properties, ensuring that something is fully open, so you're incentivized to be in and out as quick as possible, just because obviously private financing can be quite expensive compared to traditional financing. If you are in Alberta as well too, we're able to actually sign documents in-house, so you save some money on legal fees there. But we have teamed up with 3 law firms in Ontario in order to provide discounted legal fees as well too, so you're not paying full price just due to the volume of transactions that we do in both of those markets. So if you're a real estate investor, lenders are quite fickle on location, and the reason being is that typically the higher the population, the less risk, because there's the most demand for properties in the higher populations. So for us, whenever we get a client who's interested in flipping a property, typically the first thing that we're going to ask you is, what markets are you looking to flip in? If you have an address, that's awesome. If you're able to send us the MLS listing, or if it's an off-market property, send us the address and property details along with photos. A really quick and easy rule of thumb, if you're in Ontario, is we lend in populations 10,000 and above. The only exclusion to this is unfortunately Timmins, Ontario. We just find it's a little bit too rural for our appetite, even though there's a population above 10,000. I think it's around 45-ish thousand. It's just not close to any other major urban city center, we find. So for those reasons, we decide to exclude that city or that township from our lending criteria. On average, though, in Ontario, we see a lot of people flipping in, Guelph, Kitchener, Waterloo, typical of the Golden Horseshoe, Southwestern Ontario, as well as Sault Ste. Marie, Sudbury, North Bay as well too. So if we are in Northern Ontario, we do take a look at properties up there, just because obviously clients tend to appreciate the lower purchase prices on average compared to Southwestern Ontario. And if you're in Alberta, then we lend in Calgary, Edmonton, Red Deer, and Lethbridge there. We don't have a minimum loan amount. So if you are looking to flip a property, say if it's a townhouse in Edmonton, or if it's a single family detached home in Sudbury, we don't have a minimum loan. So if you're buying for, say 120, 150, there's no minimum loan requirement. The most we'll lend out on one property though is 1.5 million. So if you are looking to do a flip, say in Brampton or somewhere within the GTA where purchase prices are, in and around that 1 million or over 1 million, that's definitely something we can look to support on for those higher purchase prices if you find the right opportunity within those markets. We really focus on the lower ends to mid-market price point, single family detached homes in these populations 100,000 and above. And to provide some context as to why. So in the company's history of existence, we've found that on the lower end to mid-market price point homes, there's the most demand. They transact the most. So there's a lot of really good data in terms of comparables. And whenever there's market decreases, like we experienced in Ontario that had, 10 to 20%, depending on the property type, the community, and the city, the higher end luxury properties are more susceptible to larger price decreases. So they can decrease more in value if it's a higher end property, just due to lower demand versus the market average on the lower end to mid-market price point, single family detached homes. So we really like to kind of focus in on that niche and advise our clients to focus in on that niche, just because from what we've seen in the company's history, there's the most demand and there's really good opportunities to flip those types of properties. We have several clients as well too who flip in corporations. That's completely fine for us. We'd advise obviously to be tax efficient. I know there's some new legislation coming up that might change this, but we absolutely love lending to people who open up corporations. So if it's you and two friends who open up the corporation and you're all shareholders, we'll require app. Yeah, you have a question, Andrea?
Oh, sorry.
Yeah.
Sort of. There's no
Yeah.
camera on this. I was just saying, I just noticed that you had first and second mortgages, but I wanted to understand how the 80%, can be exercised. Because at the outset, you were saying you can lend more, even with like a smaller deposit of say 20,000.
Yeah.
But I just want to understand, because I'm familiar with Calvert, but I've never done anything with your company.
Yep.
So
Really good question. So as long as you're flipping a property or implementing the BRRRR strategy where you do renovations, you rent out the property and you refinance,
yeah.
how we're able to offer a low money down option is because we're taking a look at the as complete value more than the as is value.
Yes,
So
I
we're
apologize. I did hear
Yep.
you speak to that at the outset, so I
Yep.
understand, but I'm just saying, are these is this just generic here in the first and second mortgages that you're writing in, that it's just a general number, but I could still get the as like the after repair value to kick in at the outset so that I'm putting down less?
Yep. So our loan to value metric is extremely unique.
Mhm.
So our loan to value metric is the net mortgage. So say if you're purchasing a property for 500 grand,
Yes,
but you put $20,000 down. In this example, the mortgage would be 480,000.
yes.
We also capitalize our fees into the mortgage, so you do not pay our fees on closing.
Mhm.
So say if it's 2%, that 2% will be added on to the mortgage,
Okay.
and then we divide that by the after repair value. So as long as you're increasing the value of the property, it shouldn't exceed 80% loan to value. And that's how we calculate our loan to value on the as complete value versus other lenders who it's obviously on the as is value.
Okay.
So
Okay.
as long as that doesn't exceed 80%, which it rarely does, the only scenarios where it does go over 80% and we cannot help or support on these is if you're spending like five or $10,000 on renovations and it increases the value of the property five or $10,000. So an example
Mhm.
would be, if you're buying, say, above market value. So if the value is 500, but you bought it for say 550,
Mm.
and then you're only spending $5,000 to $10,000, and that doesn't increase the value more than what you purchased for. In those scenarios where you're doing extremely minor renovations, it can exceed 80%. The average renovation that we see is around 50 to 75, $80,000.
Mm.
So that significantly increases the value of the property. And in these scenarios, which is most of our business, it does not, it's under that 80% in these scenarios.
Okay, so I sort of follow there. But is it possible as well to get some of the like the repair value capital upfront from Calvert as well?
No,
Is that
unfortunately not. So we
okay?
require our clients to have the down payment
Mm-hmm.
as well as the renovation funds. So in
Okay.
this example, we can use the exact same example. You're buying for 500 grand. You
Mm-hmm.
put $20,000 down. You would need to have funds for the $20,000 down payment and then funds for the renovations,
Okay.
well as capital for your mortgage payments, your closing costs, enough for your operating costs, which is property tax, insurance, utilities.
Okay.
And we would just need to see that you have this amount of capital. I'll be getting into a spreadsheet that calculates all of this so that it's
Okay.
really clear and easy to understand. So we require our clients to have those funds. We
Mm-hmm.
don't lend above the purchase price. So using the
Mm.
same example, say if you're buying for 500 grand,
Yes.
and the after repair value is say $700,000
Mm-hmm.
and you're
Yes.
spending $100,000 in renovations,
Yes.
we will still require $20,000 down and we will not provide the renovation funds, even though the as complete value is $200,000 more than your purchase price. And the reason being is just the risk associated with that. So we always like to have our clients have at least $20,000 into the deal just to have some incentive and some skin in the game. Um, the
Okay.
only
No, I understand. I just wanted to clarify that too.
No, and I'm sure I'm really pleased that you brought it up because I'm sure if you have this question, others on the call as well too. So I really congratulate you for bringing it up and voicing that.
Thanks. Thanks. I'll let you continue. Thank you.
Yeah. I guess while we're on this subject, the only caveat where we can lend you the down payment as well as the renovation funds in some scenarios is if you have another property that you currently own where there's equity in it, we can
Okay.
put a temporary second mortgage on that property in
Mm-hmm.
order to give you funds for the down payment and or renovations. It just really depends on how much equity is in that property. Um,
Okay.
so that would be the one caveat where we can lend above the purchase price and provide renovation funds, but we go up to 75% loan to value in second position. So really quick and easy numbers. Say if you have a property that you own, it's a primary residence for $1 million,
Yes.
75% of that is 750,000. Say if you
Mm.
had a mortgage with TD for 500 grand,
Yes.
the calculation to understand how much equity is in there that we could lend against is 75%, so 750,000. subtract the first mortgage, which is 500,000 in this example,
Yes.
and there'd be $250,000 in equity left over that we
Mhm.
would just view as quote unquote cash. So
Oh,
you could use that 250 for either the down payment, renovations, a combination of the both. So that would be the one scenario where if you are a real estate investor or if you own a primary residence, that we can get creative with finding just leveraging other assets that you currently own that's real estate in order to find a solution that works best for you. So a lot of real estate investors within our network use it's called a collateral mortgage or a blanket mortgage.
mhm.
Solution in order to pull out equity that is otherwise sitting idle in order to scale their portfolio or do a project with paying less interest.
Okay. Yeah, no, I definitely understand that. I am a real estate investor. It is what I do principally. I just have not done a flip.
Yeah, perfect.
Yeah.
Perfect. So
But I have unlocked and used equity in multiple deals over time for additional purchases and
fantastic.
holds. And I was in Alberta too, so I did have a few
There you
properties.
go.
So
That's awesome. Yeah, I'm never sure on the context of everyone's knowledge and what they do. So I find that
no,
um
I appreciate that
yeah,
you explain that. And I like that that option is available to unlock through a second mortgage
mhm,
equity of an existing property that I have.
yeah. And then kind of building off of this, what this would look like is um you would just need to send us property photos. We don't need an appraisal and then just a most recent mortgage statement. So you have a primary residence, you go in, you take photos just on your camera phone,
Mhm.
similar to an MLS listing. You include beds, bathroom, kitchen, basement, exterior, and then a most recent mortgage statement that you just download on your whatever bank account that you have. You'd send that to us. We'd value it completely for free within 24 business hours. Say, hey, Andrea, in this based off of what you've provided and the comps that have recently sold. There's $200,000 in equity that you can use in order to purchase your next project. And then this way you're going in and having additional information on how you could use that equity for your next purchase. And this is completely for free as well too. So we find it just arms our clients better with having just knowing all the options on the table in order to purchase additional properties in the future.
Okay. Wow, thank you. This is
Yeah,
great.
yeah, no problem. Param, I see that you have your hand up. Um, did you have a question? You can put it in the
Yeah,
chat.
yeah, sorry, I wasn't able to put it in the chat. It seems to be disabled, but how do we access these products? Is that through broker channel, or is directly with you? If you can touch on that and provide some contact details.
Yeah, for sure. So if you are working with a broker, we recommend just continuing that relationship. We love working with mortgage brokers. If you are not working with a mortgage broker, you can reach out. You can reach out direct, but there's no preference at all.
Great, thank you.
Yeah, no problem. Great questions. If anyone else has any other questions, feel free um, to ask away. So we primarily focus on first mortgages. That's 97% of our business. We do to Andrea's question, we do some second mortgages. But what we mainly focus on are short-term first mortgages in those major urban city centers in order to help support our real estate investor clients. So I'm sure everyone is very curious to know for this mortgage product, what does it cost? What are the interest rates, fees? So these are our rates, depending on what province you're in. They're almost identical. So our cheapest capital with 25% down is 9.99% on an annual basis. If you put 20% down, 11.49, and then they go all the way up to 18.24. And I know you're probably thinking, Ryan, whoever in the right mind would ever pay 18.24? You must be absolutely insane to pay that high of an interest rate. And I wouldn't disagree with you, but there's always a time and a place. So where we see clients using the lower down payment option is if you're going to be in and out in an extremely short period of time and you find a really good opportunity where you're going to be exiting typically in under 6 months. That's scenario kind of number one. Number two is if you're tight on capital and you physically don't have enough for 20-25% down, we allow clients to get into the market at a lower down payment option. Yes, you're paying more in interest, but if you find the right opportunity, it's typically more advantageous to capitalize on the opportunity and profit from it as opposed to saving up and waiting for 20-25% down payment. And then scenario number three is if you're a real estate investor, typically you like the benefit of leverage. Having a lower down payment option allows you to capitalize on more opportunities as opposed to doing one deal or two deal with 20-25% down. You know, if you're in Southwestern Ontario, that could be quite capital intensive. We allow our clients to do more projects once we have a relationship and a track record. So you're able to do, you know, say 3, 4, 5 deals, putting lower amount down and stretching your capital further in order to scale and grow your business. The minimum $20,000 down in Ontario and the minimum $10,000 down in Alberta maxes out at a purchase price of $800,000. So $800,000 and below, you can put $10,000 down in Alberta or $20,000 down in Ontario. Whenever you're purchasing above that purchase price, we're going to require a little bit more down. And the reason being is just the risk associated with it due to loan to value on the as is value. This mortgage product term is for 6 months, fully open, so you can pay it out at any time, no prepayment penalty. They're monthly interest only payments, so you're not paying down any of the principal. You're just paying interest for the duration of the loan. We renew for another 6 months as long as you're in good standing. Pretty much what that means is that you're making mortgage payments on time and the property's insured. Our fees really vary depending on what province you're in. They're around 1.5 to 3%. If you have an active opportunity and you're in Ontario, feel free to reach out to Rob Maver and he can definitely provide guidance if you submit a deal through him if you're not working with a mortgage broker. If you are, then work with your mortgage broker. Our minimum fee on all of our mortgages are $2,000. So if you're buying, say, a townhouse in Edmonton for, you know, $120,000 or under $120,000, then our minimum fee can kick in. And the reason being that we have that minimum fee is just due to the human resources involved with our with transacting the mortgage internally on our end. Something that real estate investors really appreciate is that we fund properties in all conditions. So if you find a property that, you know, is a hoarder house, it's dilapidated, currently uninhabitable, but it's in, you know, a good neighborhood and you see value in that opportunity, that's completely fine for us. We typically find that some of the best opportunities of clients that we serve, the rougher the condition, typically the higher profits in most instances clients stand to make. So we're completely fine with dilapidated properties that are significantly distressed, as long as it meets our location requirements and obviously subject to due diligence of the borrower and the property itself. We love highlighting work of our clients. So if you are a real estate investor, you're active on Instagram, we love doing before and afters, creating content with our clients. This is just a before and after that we did with one of our clients. I believe it was in Windsor. So if this is something of interest of you, we're more than happy to help support in order to grow your brand, your following. If you think it would be of value, we'd love to help support in order to help grow your business. So these were just some of the numbers. So they bought for 210, put 20K down. Their reno was 40 grand, in and out in 3 months there. Sold it for 370. And then this was the profit here that they made in 90 days. The commitment fee was $4,000. Obviously, it was a fully open mortgage. Rate teen at the time was 16.49. So this one, we'll have to get an updated case study example here because our rates have gone up. But it's just essentially highlighting the details of this specific opportunity for some of our clients. This is our flip analyzer tool that we're really excited to share. I'm not too sure if Rob is
Yep, it's not letting me show my camera, but I'm definitely able to speak. but that's okay. I have a face for radio, so not a bad thing. Ryan, do you want me to take it over from here?
Yeah, sounds great, Rob.
Awesome. So this is the tool, guys, that we use to analyze all of our flips. We want to make sure that our clients are going into the deals with their eyes wide open, specifically that they have a tool that goes over all of the numbers for them. And that's exactly what this tool does. If you look in box B, it's going to cover your purchase costs, so your legal fees going into the deal. If you have title insurance in addition to that, great mouse work, Ryan. Transfer tax, because Ontario does have that. Alberta investors do not have to worry about that onerous cost. So getting a sense for what your total purchase costs are. Then we're looking at your selling costs. So getting in, then going out. What are you going to pay your realtor? Realtor fees are going to vary per province. In Alberta, at 7% on the first $100,000 and then 3% on the balance. Ontario, it's 5% plus GST. Our analyzers are province specific for the realtor commissions and the land transfer tax. Then we're also calculating your operating costs. So your electrical or your hydro in Ontario, most likely, gas, any types of utilities, insurance, condo fees, property taxes. But these are the ones that pretty much auto-populate, so you don't have to worry about those. The most important boxes that I would say you need to pay attention to are E and F. This is where you put in your renovation timeline to complete the property. How long do you think it's going to take to sell? Now, it's important when you're factoring this sell component that it's not just listing to contract, it's listing to actual possession, title changing hands, because that's interest accrues until the time that the keys change hands. Your renovation budget at the bottom there, and then your ARV, your purchase price, and how much you want to put down. Within that same box in F, we're looking at the interest rate. We are looking at what your interest costs are, the fees, and what are your total financing costs, so you can really get a sense for where your money is going. And if you go to the next slide, please, Ryan. Box G gives you a total breakdown as to where your money is going. Ryan talked a little bit about who would pay 18% on a mortgage. At the end of the deal, we're only going to approve a deal unless we think that you're going to make so much money on it that you're not going to bother paying the lender that. This tool will give you some great insight as to actually where your hard-earned dollars are going. And more specifically, too, let's talk about ROE, return on equity, or ROI is what it puts it here as, in that the higher degrees of leverage that you have, in essence, the more efficient or the more return your capital can be generating for you. And that's not to say that you should do 100% leverage on everything that you do, but there are benefits of obtaining higher leverage depending on what your business model is. Ryan alluded to the fact that 20% down, Southwestern Ontario, these properties get a little bit expensive. It's a capital intensive business. Well, this product is truly built to help people do multiple properties at once, get the most return out of their money at the same time. And when you work with us, we truly will only approve a deal unless we think it's a really good deal. And we're going to show you all of our work with this tool. The most interesting box, I would say, is H. This is going to give you your summary. Of course, what are the projected profits? What is the cash? What is your ROI? If we annualize that, just so you can kind of get a sense for how much money you're going to put in your jeans at the end of the deal, how much capital do you need, and what do my returns look like over the course of the project, and if I annualize that. So it's kind of a crude metric, but it gives you an opportunity to compare that against other projects. So say if you have a project where it's a $50,000 profit or $100,000 profit, but you got to put, $600,000 into it. But there's another one that you're looking at, and it's going to give you 40 grand profit, but you can get in and out in 60 days and put in way less cash. Well, the second one could be a better one from return on capital standpoint, plus different risk factors too. So this kind of gives you some ways to look at that. And then box I gives you some further analysis. If it takes one less month, one more month, what does your profit look like? What do your costs look like, et cetera, et cetera. So again, This tool is built to give you guys full insights on what the project looks like. We'll share ours with you in the underwriting phase. This is all out there in the open. And when you're working with your underwriter at Calvert, we want to make sure that you're comfortable with the deal, because if you guys aren't comfortable with it, then we probably don't want to lend on it. Next slide. Okay. One of the things that we've done to make our intake process a little bit more effortless for the real estate investor is we've built a renovation budget and checklist. People who are really good on spreadsheets, like myself, probably aren't good with tools. I'm pretty useless. Ask my wife. People who are really good with tools and managing projects might be fantastic or might not be as good on the spreadsheet stuff. So what we've done to make this easy is this is a fillable Word form. You go through it. It's going to walk you through every single component of the house. This way, we're going to be able to have a true idea for what your vision is for the as complete version of the property. And it's going to help us give you a more accurate repaired value, after repaired value, sorry. This is also a good project management tool for real estate investors at the same time, because what we're able to do, because it forces you to think through every single component of the home too. So it's beneficial for us to give you an accurate ARV, getting all the information outside of your head. It's also a good checklist for you too, thinking through, okay, do I need to think about the roof? Do I need to think about the basement? What about that electrical panel? And if you're going through this, shouldn't take any longer than 10 to 20 minutes. And if it gets to the point where you just really don't want to fill it out in certain circumstances, let your underwriter know. They might be able to find a different way to complete this with you. Okay, submitting a deal. Let's just talk about some of the basic things, guys. Ryan touched on some of our differences. We can fund fast. Alberta, 1 to 2 days. On Alberta, put it this way, in both provinces, we can fund within a matter of days once we get all of the required documents. Again, though, the one thing I would stress is that when we get into that situation where a timeline is tight, the better information that we get, the better result we're going to be able to produce for you. So please keep that in mind. We are happy to underwrite the deals in advance of you making an offer too. One of the things that I like about this is that it puts the real estate investor in a favorable position to write an offer. If you don't have to be the highest offer to win a bid sometimes. You could be a little bit less, but what if your closing date is in a week? What if you're with no conditions pending our underwriting? What if you're with a big deposit, quick close, no conditions, or less conditions than the other one? Well, the seller is probably going to take the bird in the hand over the ones in the bush, and we can help you be that strong offeror in those situations. We're going to send you a list of things that we need to underwrite the flip, but here are some of the things. We're going to pull a credit report. We want to make sure that your taxes are current. If we are lending to a corporation, we want to get a sense for what that corporation does in their course of business and what tax liability might exist. Proof of funds. We do need to make sure that our borrowers have the down, reno, closing, and carrying costs. We only want to put people into loans that we believe that they can be successful in and execute with, because we're not just doing this for fees. We're doing this to help you guys make money. If there's a purchase contract, we want that. We talked through the renovation budget and timeline, and then just some notes on what it is. But a lot of the people, the investors that work directly with our firm, they have a relationship with their underwriter. They know what they like to work or how they like to work. We know how you like to work. We're going to move in the fastest and most efficient way possible. We're going to ask for 2 documents. If 2 will do, we're not going to ask for 5. So again, we're going to send this all after the fact, but we really want to make sure that we're doing right by you guys, giving you the service that you need.
Rob, do they have to submit this document every deal that they submit?
Oh, good question, Ryan Day. So application, we'll pull credit report, notice of assessment, those are done, and corp docs, those are done on an annual basis, or your filing period, depending on how often you're remitting taxes. So if you have GST or source deductions in your corp, those docs as little as one time per year. So you don't need to worry about constant credit pulls, having to resubmit things that you just submitted on previous deal. We keep a general file for all of our potential repeat clients on hand. Now, the renovation time budget, your rental list, that's going to be case dependent, specific to your project. That's something that we need to see on a deal by deal basis, because that can and should change. No two projects are the same. They all should be a little bit different, but otherwise the balance of the documents, we're going to keep those on file, so we don't need to ask for the same thing over and over again. There's some flippers that I do work with. We have our process so buttoned down where they send me one email, I get back to them right away, and we can get them an answer within 2 to 3 business hours because we have all their docs on file. So that's kind of the gold standard, and that's the type of service that we're looking to provide to you guys. This is our awesome underwriting team. In Alberta, you can reach out to any of these great people. In Ontario, you are required to work through me for now. That is because FSRA recently implemented some regulatory changes with the licensing requirements for lenders to deal with clients direct. So right now I hold those credentials, and we are working on getting more. So Alberta, anybody, Ontario, again, would love to connect with you. And I think at this time, Ryan, are we going to open it up some questions?
Yeah, you bet. No, it's probably a lot of information to take in. Does anyone have any scenarios, examples, curious about anything related to our financing in general?
Questions on investing in real estate. Some of the other things too, I don't know if we touched on this, guys. We've built our business to be in support of you guys. You are our ideal client. We have a lot of great things like economic reports. Ryan, stop me if we talked through any of this before. Economic reports specific to the areas that we're lending in. We're going to follow up with where you can get that, so you can get a sense for what the benchmark price is, what days on market is per asset class, where are most of the properties transacting price point wise, so you can have a better appreciation for that market that you're looking in. We like to do webinars like this. After you go have a great deal and you turn a big profit, let us know. We can build a case study. If you're a contractor, let's build a case study to help promote some of your work. If you're a real estate investor using this to raise some money, let's talk about that. Ryan started a podcast. We're looking to bring on some cool guests and people that can talk about their perspective. If there's anything that we can do from a marketing or a business development standpoint, let us know. We want to hear what those ideas are and see if we can action it to be in best support of you guys.
One other thing I would also mention as well too is, as long as you are selling the property once the renovations are done, we are underwriting or taking a look at serviceability through the capital that you have liquid ready to go. You don't need a super high income in order to qualify for a mortgage for an $800,000, $900,000 purchase. As long as you have the capital and you have the right opportunity, and you can show us that you have the capital in either cash or debt or a combination of the both, that's mainly what we're taking a look at in order to underwrite serviceability. So if you're, to Rob's point, a contractor, to be tax efficient, you show that you make 30, 40 grand a year. That's completely fine for us, as long as you have the capital. Say if the project, when we run our numbers, it shows that you need to have $125,000 in capital in order to do the deal. If you have $50,000 in cash and the rest on a line of credit, that would suffice. We're able to accept cash, lines of credit, joint venture agreements, HELOCs, gifted funds, as long as there's documentation. Also credit cards as well too. If you are going to be using other high interest debt, we just like to see that you obviously have some skin in the game and you're not too leveraged. Rob could definitely walk you through that as well too, once you find the right opportunity. But we don't underwrite traditionally like other lenders. It's if you have the capital and the right project, we're going to do everything within our realm to get the deal done in order to help serve and support you. I see that Barbara, you got a question there if you want to unmute yourself.
Hi there, Ryan. Yeah, two questions. You mentioned something about a wholesalers list. Is that what you have, a list of wholesalers that you can share with us? Or what was
Yep.
that point that you made?
Yeah, you bet. So there's quite a few in Ontario that we've done really a decent amount of business with. So after this, along with the recording, our product sheets, we're going to send off those. It's a PDF to sign up on their buyers list. So then you're able to find other opportunities that are not on the MLS in order to help you do the next deal. So we have some for Alberta and Ontario. You'll be getting both.
Okay. Okay, fantastic. Can you speak to, I've never worked with a wholesaler, so can you speak to the fees? Are there, when so the wholesaler has a property, let's say for, 400,000. I've heard somebody say that there could be fees in addition to the 400,000, but then I spoke with somebody else and they said, oh, no, our fee is in the 400,000 already. Can you speak to that? Like, what's the actual case? Does it depend on the wholesaler or?
Yeah. Really good question. Two points to this. So each wholesaler, and I don't want to speak on their behalf, but typically their business model, their structure is they get a property under contract. Using your example, say if they get it under contract for 380, then they charge their fee on top because that's how they make money. So in
Yeah.
that example, say if it was 20 grand and they're trying to assign the property for $400,000, so
Yeah.
that will be their fee.
Okay.
Most lenders will consider the 380 the purchase price, and you will need to pay that $20,000 fee on closing. For us at Calvert, we consider the $400,000 the purchase price.
Okay.
Does that make sense?
Yeah, sorry. So, say that again. So the 380 is the purchase price, and then we would have to pay the 20 commission to the wholesaler on closing.
Depending
Yep.
on the lender. So
Okay.
for Calvert, we consider the $400,000 the purchase price. So if you want to put 20 grand down, 20% down, it would be on the $400,000 price that you are purchasing the property for.
Got it.
Yeah.
But when you said paying, okay, so the 20,000 to pay the wholesaler, that's what you said. The 20,000 would be paid on closing to the wholesaler, right?
Correct. And how this works is you agree to buy my house. We could use an example. You agree to buy my house for this for 480. Okay. And
Yeah.
it closes in 2 months. Typically what their business structure is, they get it under contract. And then they have, in this example, a 2-month period to assign it to someone else prior to closing. So they never close on the property. On closing day, it would go from me to myself to whoever you assign if you were the wholesaler in this scenario.
Okay.
And then
But
they charge their markup and they get their fee on closing day.
Can I jump in and maybe offer some clarity on that, guys?
sure.
So what a wholesaler does, Barbara, is they buy a property. So let's just kind of talk through a hypothetical example here.
Great.
Wholesaler buys your house for 300. They sell it on assignment for 400. So most all other lenders would consider the purchase price being 300 because they don't see value in that assignment. So
Right.
you would be putting, in order to close, you would need to pay the $100,000 assignment fee plus whatever down payment that lender would require, typically 20% at least. With us, we lend on that assignment fee. So we could lend up to 380 in that scenario, if that makes sense.
Okay. So
So,
then,
so
so then the
yeah, so you're
20,000 I would have to find to pay the balance to the wholesaler.
Well, we just consider that. So whenever we're doing a flip
Oh.
barber, we need to make sure that we're seeing the down, close, reno, and carry. And in this instance, that's, that would be part of the down payment. So what's going to happen is when you go to close on that property at the lawyer's office, they're going to say you need to bring in this much to cover the legal fees, the transfer tax, and the down payment. But we'll work through those numbers with you in advance to make sure that you're set up for success there. But I think the key takeaway is kind of, wholesalers buy for one price, they mark it up, they sell for another. We will lend on the higher of the two. So you don't have to worry
Yeah.
about coming up with
Oh,
the entire wholesale fee. If that's
okay, got it.
if I'm
Got it.
picking up what
Okay.
you're putting down.
Okay. All right. Thanks. That's great. And a second question, there is an example early in the presentation of a house, somebody making 115,000 profit. Where was that?
I think that might have been Windsor, Ryan?
Yeah, yeah.
I see. Was that recent?
Yep. Yep.
Uh-huh.
We
Okay.
work with a lot of to give some context to the people on the call. Last year we loaned out about what, Ryan? $350 million.
Yeah.
So our
Wow.
average mortgage size is floating around $390,000. That's a lot of loans. We see a
Yeah.
lot of this stuff. So we get a lot of reps underwriting this type of business. So we know what we're looking at. The cool thing about this too, Barbara, so I mentioned our economic reports that
Yeah.
we have. But what we also do internally with our valuations is we're gonna, more often than not, share that information with you. So you can get a sense for what the comps are doing, how long they're sitting on the market, how much inventory is there. So
Yes.
we
That's great.
we have a lot of great resources available to us in that our valuation department is for appraisers. Two are designated with the Appraisal Institute of Canada. The other two are Scenaria, Canadian National Real Estate Appraisers, I think the acronym is. All of our underwriters are licensed brokers, realtors, and I've done the appraiser stuff too. So we have some access to some great data. We're going to share that data with you. We have a lot
Perfect.
of reps looking at this business, and we're going to show you our work.
Okay.
Um,
I'm very interested to get those reports. Yeah, especially
yeah,
in Windsor, because there's so much economic activity going on now, and in the next 5 years, it's just exploding in Windsor.
Windsor's kind of different, border towns. It's not. It's border towns kind of beat to the tune of their own drum in the sense that they're not going to be as congruent with what Toronto is doing. But
Right.
again, if you sign up for our economic reports, you can go on our website and download them. You'll see things like days on market, delinquency rates, price point per home, what's moving, days on market. There's so much good information on there.
Terrific. I'll look for it. And to that point, do you also, so we can, on your spreadsheet, we can say, oh, we think it's going to take a month to sell. And surely that would be based on some research we've done. But do you
Sure.
also comment on that if we're wrong? Like if you might say, in that market, we know currently it's not going to take a month. You should plan for 3 months. Do you comment on that as well?
Oh yeah. Now
Yeah.
here's the thing. I'm not infallible, nor is my team.
Well, of
If
course.
somebody says they're going to sell it in 1 month, in the background, I'm stress testing those numbers at 3 to 4 just to make sure that it makes sense. Because
Right.
lenders are we need to be pragmatic.
Yeah.
Investors need to be optimistic.
Yeah.
So how do we balance out the two? What I do in that instance is I'll kind of say, hey, if it takes 1 to 2 to 3 months longer, how does this look? You'll get my opinion on that and see those numbers. But when we're inputting those numbers, we're going to be basing that off of what, what kind of possession that you think that you'd be looking to negotiate. So immediate 30, 45, 60, 90 days type thing. And then what
Yeah.
your average days on market is for your comparables and the active inventory in the same community as well. So
Okay.
we're going to run that analysis based off of the data that we have available to us, which is all the MLS data, and then your investment criteria for that project.
Oh, gosh. Okay. Thank you.
Got it.
Param, I see you have a question there? Or your hands up? Nope. Alrighty. Any other questions from anyone else on the call? If not, I will take silence as golden. We'll make sure that our marketing team sends out all of the materials referenced on this call. If you have any questions, comments, mock scenarios, live scenarios that you want to run by us, feel free, call, text, email, whatever works best for you. More than happy to help support and provide educational material in order to help make better financial decisions as it relates to real estate investing. Thank you so much for your time, everyone. Really appreciate it. And have a fantastic day.
Can I try once again?
Yeah. Okay. There you go. Yeah.
Oh,
Prom.
there we go. Okay. Sorry, I was having audio issues. For going back to that collateral piece, does it, just wanted to confirm, does it matter if the purchase is under a corp, but the other property that's being used is under personal name? Any issues with that?
No. Is the question, you're buying in a corporation, you want to collateralize a property held in a personal name? Can we mortgage multiple properties with different title holders? Is that the question?
That is correct, yes.
Yeah, no problem. Easy peasy. We do
Perfect.
that often.
Okay, thank you.
You got it.
Oh, and one other thing, Rob, if you are able to comment on it,
Sure.
I'm sure just in terms of comparing this, your product to the other private lenders, how is this superior to the others? I mean, not just in terms of the rates and such, but just holistically, how is this superior to the private lenders that are here in Ontario?
How much time you got? No, so kind of some of the things that I would mention, Param. One, we've been lending to real estate investors since before I was born in 1982. So we have a very long track record doing this. We have loaned through, as a result, many economic environments. The 90s were tough. We went through 08. We survived that. 22, we've managed a lot of good markets. We've managed a lot of bad markets. So with that comes a lot of experience and expertise in how to handle when things go well, but also how to give our clients guidance when things don't go well, because that happens too. Some other things, Prom, is we're a reliable source of capital. So it's not like we, need to go out and raise it, or you need to worry about the money being there. We have a big facility with a syndicate line of banks. We have a lot of equity ready to go, other debt instruments. So we're good for the money. Our team has built products, has worked through a lot of files to serve you in terms of being able to give you the speed that you need to capitalize on the good deals. You don't need appraisals. We can give you after repaired valuations. No other lender can do that. Every other lender is going to require an appraisal. We can lend on the assignment fee, as I touched to on Barbara's question earlier. Also, when you look at the terms of our debt, it is very fee friendly relative to other options. There might be some other options that have lower rates. Look at the fine print. Is there a minimum prepayment period? Are they going to hit you with different fees, such as discharge fees or renewal fees? We operate in good faith, not to say that other people don't, but we're very transparent in the solutions that we present. Also, our closing process too, it's streamlined. We have interviewed probably about 30 firms, I would say, since we went into Ontario. We do the bulk of our business with 3. These are lawyers that know our paper, know how to move quickly, know how to deliver in tight scenarios, and do so while providing a great service at a fair cost at the same time. That's not always the case with all other lenders. And simply put, if there's a scenario, somebody on our team has managed it before. So you're dealing with a lender that has been doing this since 1982, that has loaned through many different market cycles, that has seen things go great, that has seen things go poorly, that has been able to manage the upside and downside risk through all those tough and bad times and good times. We have tools for you. We have marketing opportunity to celebrate your success. And we have a team of experts ready to kick ass for you as soon as you send in your deal.
Great. Thank you so much.
You got it.
Any other final questions?
Hi, can you hear me?
Yeah, you bet.
Okay, great. Yeah, I just on the spreadsheet, terms of the fees. So I see I saw that it says commitment fee and then minimum fee. Can you are those two separate fees?
Nope, that's one fee.
Okay,
The minimum fee will be the exact same. It's just whenever there's a purchase price, below say $100,000, for example, that
okay.
lender fee, due to the small loan amount, will trigger our minimum fee of $2,000.
Oh, got it. Okay.
Yeah.
So the range is between that when it says commitment fee, it's between 1% to 3%, and that's based on the actual percentage is based on the purchase price, right?
Nope, the mortgage.
Oh, and the mortgage. Got it. Okay.
Yeah. So if you're buying for 520, you put 20 grand down, the mortgage is $500,000. In Ontario, the fee will be 2.25 and capitalized into the mortgage. In Alberta, our fee structure is a little bit different, so it can range from 1.5% to 3%.
Okay. Thank you.
Yeah, no problem. Really good question. And another thing to note, if you're looking at, I guess, other lenders, is it's common that you would pay that fee on closing, where we add it onto the mortgage and you pay it whenever you sell or refinance the property. So it's backloaded.
I see. Okay. Good to know.
Yeah. Fantastic.
Okay.
Awesome. Well, I really appreciate everyone's time. Again, feel free to reach out any questions at all. More than happy to help answer them. Don't feel like you're being a burden. We'd love to hear from you. Cheers,
Thank you.
everyone. Thank you.
Awesome. Thank you.
Thank you, Ryan. Have a great day.
Thanks, you too.
Bye.